Hello, everyone, and thank you for joining us today. Welcome to this fun deep dive live. Today, we'll be discussing one of our newest ETFs, the Simplify Piper Sandler US Small Cap Plus Income ETF, ticker symbol LITL or LITL. LITL launched April 28, 2025. We believe this differentiated approach offers investors a powerful way to gain exposure to US equities, US small cap equities, plus receive an income driven by a proprietary option-based income overlay. LITL is an actively managed strategy and sub-advised by our friends at Piper Sandler. Simplify is very excited to highlight LITL today. But before I get too far ahead of myself, I should point out that today's discussion is for information and educational purposes only. With that in mind, to make this as useful as possible for you, we welcome questions and invite you to submit them through the Q&A function at the bottom of your screen. The chat function is disabled for this webinar. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. Joining me today is Michael Kantowicz, also known as Cantro. Cantro and I go way back to my days at a previous employer. One fond memory I have is when him and I did a little road trip up to the Field of Dreams about a decade ago. Michael gets extra credit for joining us today while on his family vacation. Welcome, Michael. Can you introduce yourself and tell us a little bit about your firm?
Sure, absolutely. And thanks for inviting me to speak and join you, Jeff. So I'm Michael Kantrowitz. I'm the Chief Investment Strategist at Piper Sandler, a public investment broker-dealer. I have a team of four other members that we've worked together over almost 20 years now. So my history goes back a little longer than that. Piper Sandler acquired my prior firm, which was Cornerstone Macro, a macro research boutique catering to institutional investors. Cornerstone Macro was started in 2013. Before that, I was the chief strategist at Wolf Research, and before that, ISI Group. And I started my career a little more than 20 years ago at a small firm called Merrill Lynch.
Excellent, excellent. Let's talk a little bit about your accolades, Michael. I'll share the screen here. Michael has been a multi-winner of top research firm on Wall Street, entity known as Institutional Investors many years ago. So that award does not come without great research, great insights, and opportunities for clients to benefit from the research process. Michael, you talk a little bit about that award and how that has been awarded to you multiple times.
Sure. Thanks, Jeff. Yeah, so in 2024, last year, most recently, I was ranked top portfolio strategist by the annual institutional investor survey, now run by a firm called XTEL, but formerly Institutional Investor, and have been ranked many times in the top rankings over the last several years. And there's probably about 30 to 40 strategists on Wall Street across all the major and smaller boutique firms. So it was quite humbling and a great victory for me and the team to be recognized by our clients for all our hard work. So that's one of the ways that we're recognized, and hopefully we'll continue that in the years ahead.
Yeah, well, I've been using your research for decades and love your insights and perspectives. So let's get a little bit deeper into U.S. small caps specifically. I just want to remind investors that historically, small caps generally provide a bit more opportunity for growth and margin expansion than some of the large cap securities in the marketplace. That does come with increased volatility. Traditionally, you could see small caps doing very well as the risk appetite increases as the economic recovery can happen in the past. Historically, you kind of see small caps lead the charge out of a recessionary period. We're not making any sort of calls that time is here today. And then small caps generally have less foreign revenue, so less fluctuations due to currencies or trade tensions. It tends to be more localized from a revenue perspective. And just, again, it's an asset class that people do allocate from time to time. And I think the opportunity with us with LITL is to get a true stock picking portfolio where Mike and his team are taking these great research processes they have, providing that mosaic theory of looking at multiple variables to determine where to be positioned in the portfolio, and that's what we're going to dive a little bit deeper into right now. So with that said, Michael, can you talk a little bit about kind of the way you guys start to unpack or unbundle the complex world of financial markets with rates, policies, earnings, multiples? There's a lot going on in the financial markets, and you guys have a way of putting all the pieces together and making sense out of it.
For sure. Yeah. And it certainly doesn't seem to be getting any easier with the amplification of all the news and social media, et cetera. So yeah, we've developed a framework over many years of both being exposed, obviously, to the market. My career started before the GFC, or global financial crisis, so I've experienced that, and there's been, I would say, somewhat of a new normal over the last 20 years compared to what we all believe and read about in terms of what is normal, or what we think of as history. So we're always looking to adapt and never committed to a single view or idea of how something should work. Our process is simple, I would say, in terms of taking something very complex, very difficult to forecast, and distilling it down to a recommendation of a portfolio. And so we start off with a macro process and framework, and our macro views ultimately drive our security recommendations. And that's largely due to our belief, and this chart that Jeff is showing quantifies this, that macro plays an enormous role in explaining individual security returns. In fact, about on average over the last 30 years or so, macro has explained about, we'll call it 75% of the average stock's return. So what does that mean? Well, when all stocks are moving up together or down together from some macro event, whether it's an issue with inflation or reacting to what the Fed is going to do, or how the economy or consumer are behaving, how the job market looks, et cetera, those are all macro forces. And the list is obviously extremely long. And we're always trying to figure out, what are some of those most important macro forces, because there's so much macro data one could analyze, but really understanding which macro data are the most important in a given time is extremely paramount. And so we take our macro framework and try to figure out, with a bunch of different tools that corroborate each other, where the momentum in the economy is headed, and which parts of the economy are leading or lagging in that view. And so we take a traditional approach, looking at how changes in Fed policy affect the outlook, how changes in inflation and changes in fiscal policy. So those are three major classic drivers of the macro cycle. But then we're always looking into other facets, such as secular themes like AI, or back in the early 2000s, the proliferation of social media, the internet, et cetera. And so we take a lot of different tools using a pretty broad framework to narrow down a high conviction view on where the macro backdrop is headed over the next, let's say, 6 to 18 months. Looking far beyond there is really difficult, and the ability to forecast with accuracy is extremely challenging, and the markets often, of course, don't look that far ahead anyway. And so our process, maybe Jeff, we can go to the next slide,
Sure.
is somewhat simplified in that we've developed a framework over the last several years, which I refer to or coined the name HOPE, that helps us in a very simplistic way look at some of the most important parts of the macro backdrop to understand and map where we are in the business cycle and whether or not we're moving into another regime for the business cycle, because a different regime in the business cycle often leads to a different regime of equity market leadership. And so the HOPE framework is a four-letter acronym which represents housing is the H, O is orders, P is profits, and E is employment. And essentially, what that is the sequence in which the economy traditionally accelerates and decelerates. When you have a bad employment backdrop where unemployment is rising, we often refer to that as a recession. The beginning of a US economic recovery, traditionally and very consistently, particularly a broad one, has always begun with a improvement in the housing backdrop. So instead of looking at hundreds of macro data and trying to figure out where each one of them are going, we've really narrowed down a framework and identified these four sectors of the economy as being the most consistent across history and important in terms of their signal for where the macro momentum is headed and what market leadership is likely to be in that outlook.
Yeah, obviously, Michael, in this whole framework, I mean, housing is driven by lots of variables. Interest rates seems to be the top of mind.
Sure.
Mobility of workforce, supply demand. There's more demand than supply, but there's a lot of things that go into that first category, and
Yep.
therefore you put some analytical frameworks around housing, and that gives you a positive. Things are the tailwinds are behind you, and it gives you the opportunity to position portfolios based on one variable of housing, and then you combine that with the other letters of the alphabet with hope and just put that mosaic theory together. And then that helps you identify how to position whether you've got a cyclical tailwind or, some sort of headwinds towards economic growth. Those are all things that go into your thinking process, right?
Yeah, and housing in particular is helpful in understanding the breadth of the economy, and I would also say the breadth of the equity market. When housing is getting better in the U.S. economy, that's typically a sign that rates are accommodative. And when rates are accommodative, that's typically a sign that both consumers and businesses are starting to spend, invest, hire, and becoming more optimistic. So that's it not only kind of helps us understand where we are in a business cycle, but it also helps us understand whether the macro outlook and therefore the earnings outlook, which plays into leadership of the market, is broadening or narrowing, which I think has been a really important theme over the last few years.
Yep. Yep. Yeah, one of the things I learned early in my career is that, equity markets are driven by, multiple expansion or earnings. And a lot of
Yep.
times we get too focused on, just the E part of the equation, but multiples generally migrate up and down based on like leading indicators, right? And so earnings, is a great way to kind of anchor a process, which is kind of the
Yep.
third step in your hope framework here. But how do you think about multiples in the regard to this kind of framework?
Yeah, that multiples is we could have a whole hour discussion on
Sure.
equity market multiples and value and growth. And that's something that I have learned throughout my career and have come to conclusions that are, I think, quite different than what we're often taught or told by our elders or what we read in textbooks. And yeah, you're definitely correct that the multiple of, let's say, if we take an equity index, the multiple of the index typically reflects obviously the sentiment, how much investors are willing to pay for a given dollar of earnings
Hmm.
on where those earnings are headed. So the earnings cycle or the profit cycle play a big role. And um, the profit cycle and the business cycle kind of go hand in hand. So
Sure.
you can use those interchangeably. The other factors that influence multiples and whether they go up or down in a given year or in a given quarter or a given month are more about macro issues. And I'll name a few because they've all kind of hit us in the last several years. When inflation surprises the upside, that's typically a backdrop where macro risks are rising and multiples typically reflect and move lower. Interest rate sharp surprises in interest rates, typically when the Fed's beginning to tighten interest rates or raise interest rates, typically is a backdrop where multiples are under pressure.
Hmm.
Rising unemployment is another one. So When I think about my career, and I've studied a lot, pretty much every market pullback in history, or at least going back about the last 80 years, you can bucket why multiples and ultimately markets decline into three separate silos. And they typically revolve around, again, big upward increase, unexpected increases in interest rates and inflation. So we certainly saw that in 2022.
Mm-hmm.
Uh, Increases and accelerations in unemployment, and that's typically what a recession is. So recessions typically lead to wider credit spreads, which is another measure of macro risk, and lower multiples. And then the third bucket is kind of a catch-all. When you think throughout history, it's kind of everything that doesn't fit into those two categories, employment and interest rates, which is exogenous factors, from everything from country currency crises that affect U.S. markets to in 2023 there was a regional banking crisis, or at least for a few companies. President Trump announcing tariffs in early 2025 was certainly a shock to the market initially. So these are all these exogenous idiosyncratic shocks that could also, again, just introduce macro risk into equity markets, and that manifests itself through multiple compression.
Yeah, so I like the framework. It tries to, as you said, simplify, a foundation to build upon. And then once you kind of get a lay of the land, what is your process? What's your thought process after that? Maybe that's a segue to the next slide here.
Sure. So our process is built upon looking for consistent behavior of investors throughout these different parts of the business cycle. So this illustration here shows a very simple bell curve, and you can think about the curve as the profit cycle accelerating from the bottom left to the top middle to decelerating along the right top to the bottom right. And as the profit cycle accelerates and decelerates, a bad deceleration can result in a recession. And then you come out of that typically with some stimulus from the Fed lowering rates and maybe some fiscal stimulus, and then you get a nice strong reacceleration. And so we see very consistent performance of different types of companies. So we'll call them fundamental attributes that investors seek out in these different phases of the market cycle or the business cycle. So classically, at the beginning of a broad-based economic recovery coming out of a recession, that's where you typically see a lot of initial speculative behavior of investors, really buying stocks less driven by their idiosyncratic fundamentals or company-specific fundamentals, but just really buying companies that perhaps have gotten too beaten down in an economic downturn, and you're starting to come out of it and see a better economy ahead. So investors typically more broadly buy risk and deep value stocks during that phase of the cycle. As the economy reaccelerates and the recession is behind us, you typically see cyclical parts of the financial markets outperform. And oftentimes, when I use these words, value and cyclicals and risk, they're often referred to using sectors. So we typically hear financials and technology and industrials and materials, very cyclical sectors. Our process is more rooted not in sector selection and trying to identify which sectors are going to do well at these different phases, but really more fundamental attributes. So looking for value and small caps, as you mentioned, at the beginning of a reacceleration of the economy. And then as the business cycle ages and things start to slow, interest rates go up, you tend to see investors flock to areas that are more offer quality and have stronger fundamentals that can better withstand macro risks starting to come in that you typically see late in the cycle, whether it's higher inflation, higher interest rates, or even higher employment. And so that's where you typically see that shift from value to growth. We just get to, we have a process that gets a little more deeper in the weeds rather than just saying go by value or go by growth or large caps or small caps.
Yeah.
And so this is kind of a high level illustration of our process. And again, what we're trying to do is figure out where on this curve are we
Hmm.
and where are we going to be over the subsequent quarters, and therefore pull together a basket of stocks that fit the attributes where we think the market will be heading, and therefore what types of stocks investors are going to be seeking out, irrespective, importantly, of their sector.
Yeah, maybe Michael, we've both been around a long time. There's most recent example probably was the COVID period where market corrected very, very quickly, and then recovered with not a traditional source of recovery led by value, like in the
Yep.
08, 09 time period, but it was more, quality led on the way down and quality led on the rebound. Can you give us an example of how you were making adjustments to your views kind of in that COVID period? And then, I'll probably ask you a little bit about, a couple sentences around the global financial crisis. I remember that well back
Sure.
in, I guess it was April of 09, a very difficult period in the market when it rebounded from risk off sentiment to risk on.
Yep.
Different leadership post the correction.
Yeah. So, with COVID behind us, I feel like I want to say, but I don't want to jinx us, that we've seen pretty much everything that can be thrown at us as investors and analysts. But yeah, that would certainly go in the third bucket of an exogenous shock. Obviously, it did lead to I think was a 1 or 2 month official recession. But yeah, it was certainly not your traditional business cycle downturn. And so as that started to ensue, and it did happen quickly, basically the markets only fell for about a month and a half. The key catalysts for the market bottoming, or one of them, back in March of 2020, was the Fed stepping in and providing enormous amounts of liquidity to both financial markets and the economy, which was then compounded by fiscal stimulus. So those are the traditional routes in a recession of stimulus and or events that tend to mark the lows in equity markets, because of course equity markets are somewhat forward looking, and that provided some relief from the risk that financial markets were going to continue to be disrupted and not function correctly. So once we had that policy stimulus, and it was kind of a we're going to do everything it takes moment from
Hmm.
the Fed back then, we recognized that that was a likely bottoming in the market. And what was tricky, though, as you mentioned, though it wasn't your traditional economic recovery, it wasn't because we didn't have enough stimulus. It was because the economy literally was not fully reopened, both in the US and globally. So we did this was a good one example where we somewhat, and I would say somewhat, overrode our traditional framework because of the understanding of and the uncertainty around when the economy would more broadly pick up. And so we did have a bigger preference for highly profitable growth companies, which many of the stay at home companies that went up a lot, at least until we got the vaccine, were kind of in that bucket. And so as 2020 progressed and we got the vaccine, which I would say was called the medical stimulus, if you will, that was for us and clearly for the markets a major signal, and that was in November of 2020, that we were now seeing green shoots that the economy has the probability of reopening, and we can see a more traditional, broad economic recovery, not just a handful of companies that investors and consumers were using and investing in at a time where the economy was closed. So in 2021, we made another shift in our framework to overweight companies that were more value, more
Hmm.
cyclical, more risky, and that would certainly fit into the small cap world, as we saw the beginning of a pretty broad-based macro rebound take place. That coincided with a big broadening of earnings revisions and a pretty strong year, obviously, for equity markets in 2021. Should we go into 2022 or?
Yeah, just maybe a real quick because I remember it well. In the global financial crisis,
Yep.
markets were off over 20% the first 2 months of the year. March, April time period, one of the banks came out with reasonable numbers and the market took off. And I remember specifically that was an environment where you just kind of had to hold your nose and lean into deep value, negative momentum, high beta, and
Yep.
that was rewarded for the next 9 months or so. But anything I missed there that you guys would have
Well,
pivoted on?
just yeah, one of the things I think that makes our process unique and why I think our clients value our work and why it stands out is we not when we are evaluating the markets, we're of course looking at all I think generally the same macro data and market data that most analysts are looking at. Of course, you look at the indices, you look at sectors, but we've for many years now, I'd say over 15 years, have been very focused looking at fundamental attribute baskets, or what is often referred to as factor baskets.
Hmm.
And we believe that this is not only a superior way to think about constructing a portfolio, but also a more consistent and reliable way to evaluate what is going on underneath the market. So a quick example, if you're looking at the S&P every day, you can see, what the index is doing, the S&P 500. But in the recent years, that's been largely concentrated in a very few number of names. So it's not giving
Right.
you a real good idea of what's going on more broadly to the average stock. The same issue is seen in looking at sectors because sectors are just pieces of the pie of the market. So you have that same cap weighted bias where a very few names could be giving you a signal that's not representative of the average stock. So
Hmm.
we look at these factor basket portfolios as we believe that it's a more consistent way to understand what's going on in the market. And there tends to be more signal, in our opinion, than noise in looking at those week to week, month to month, into understanding what parts of the market are leading and what the market's rewarding and what it's avoiding. And the benefit of these factor baskets is that they're largely sector neutral and they're equally weighted, which means that not one sector or one stock could be driving the signal. And our process is very much built upon the idea that breadth of a signal is a very important part of the process. In other words, there's never one stock or one sector or one macro data point that's going to push us to make a decision. We like to see, for all intents and purposes, the stars align ideally,
Sure.
but
Yep.
a lot of signals from many different areas of the market.
Yeah, when I think the kind of the summary I think about when I think about the Piper process is there's a lot of data points that a lot of other folks are looking at. We get professionals with experience that are interpreting the data. We're not just running a machine that's generating output. There's some interpretation of the data. So maybe by way of keeping moving forward here. So just a high level investment process slide here. So we're leveraging our friends at Piper Sandler, very well accredited in the marketplace, very well known in the marketplace by the institutional investor poll that Michael mentioned earlier. What we would call this as a business cycle, fundamental drivers of economy, housing orders. There's this hope framework. So they're doing all that mosaic theory around inputs and making decisions. And then the plus income part of it we haven't talked about yet. I'll go through that here in a moment, but that's where we provide a proprietary income overlay to US small caps, which is in general, investors aren't looking at small caps for income, but we have a proprietary way of generating income here at Simplify that allows investors looking for income across multiple market caps can gain exposure to that. So just again, looking at the construction, we've got the business cycle analysis. That's a comprehensive analysis that Michael and team do. We look at the Russell 2000 investable universe. As always, you got to have to get rid of some of the illiquid part of the benchmark. Roughly 20% of the names get eliminated. We take the inputs from Piper Sandler as far as their selections of attributes that results in about a 200 stock portfolio. We rebalance it monthly. It's sector neutral, so the drivers of The performance are going to be our ability to differentiate individual securities within a particular sector. Mike and his team do have the ability, if warranted, to make changes intra-month. We're not at the mercy of a rebalancing schedule per se. If we get, good news, bad news in the next intra-month period, we're able to make adjustments to the portfolio. So use cases, obviously investors are familiar with small caps. I mentioned earlier some of the attributes that that would provide. Again, this is going to be a very, very high active share, over 90%. So it's going to be very different than the Russell 2000. We feel like it's a good use of capital, and the correlations to large cap and foreign securities are there. And then in the event that we do see, economic growth, typically less currency tariff sensitivity for small caps. Maybe just by way of just a little bit of headlines around when we have the word income in the title of this particular product of LITL. What we're doing there is we're actually selling an out of the money put option. So we get proceeds in, we buy a further out of the money put option. We limit that spread, if you will, and that creates income. That gets rebalanced on a frequent basis within the portfolio, and that gets distributed to investors. One question we're getting from the panel here is what would be an anticipated distribution yield or distribution rate for LITL. We're anticipating about a 3 to 4% annualized distribution rate for LITL. So with that, let's see if we have any other questions. Michael, anything you want to add while I look at the questions coming from the panel?
Well, I'll just say I think it's a really timely time to for a product like this, and just one of the things I'll point out. We know small caps in recent years have not been in favor. You've had the Mag 7, Mag 7, Mag 7, but we believe that it's been a better backdrop within the small cap space to be an active investor. There's a lot of discussion over the growing increase of passive investing impacting large caps, and that's been obviously a benchmark that's been difficult to beat. But I would say in the small cap space, where it's far less covered by Wall Street, there's on average only 2 to 3, maybe a few more analysts, in some cases zero, covering these stocks. We believe there's more opportunities there to be a stock picker. And that's an area where investors can benefit, I think, more so from being in an active portfolio versus buying an index like the S&P 600 or the Russell 2000.
Okay. So again, headlines: active management, great team of folks at Piper Sandler that are implementing their investment process. You get an income stream from small caps, which is unusual in the space. I guess that's approaching the end of our session here. So I'd like to thank everybody for spending a portion of the day with us. We appreciate your time. Michael, thank you for sharing your perspectives, insights on the business cycle modeling process, and that how investors can use that to benefit their portfolios. All of us here at Simplify are excited about the addition of LITL to our lineup. If you want to learn more, if you have any questions, if there's anything not clear from today's discussion, I encourage you to reach out. We're here more than happy to help you with those particular questions. And before I sign off, a heads up that our next Fund Deep Dive Live will occur Thursday, September 18th. My colleague Chris Getter will be discussing Simplify's Kane Anderson Energy and Infrastructure Credit ETF, KNRG. Have a wonderful evening, and thank you.